Recording in progress.
Good morning, everyone. On behalf of Axis Mutual Fund, I welcome you to this brief but hopefully valuable webinar that we will try and take you through today for the next about 60 minutes on what is a quant fund, how does it fit into your portfolio, and more importantly, what is the new advantages that you get out of investing in such a product. My name is Raghav Iyengar. I am the Chief Business Officer for Axis. I'm a chartered accountant by qualification. One of the reasons I got into mutual funds about 20 years back was largely because of the product that I'm going to talk about. Data has always fascinated me. The way people spend, the way people allocate their money to various asset classes, the way, behaviorally how things are moving is actually far, far more stimulating to me than a lot of other professions. Want, as you know, is a very, very funny word, right? Most of us, even, for example, even someone like me who's been in the financial services world, for me, it's a bit of a Greek and Latin word. It's like, what is quant? And when you expand it and you make it this full form, which is QUANTITAVE, and you say like half the time, most people don't get the spelling right, me included. So it's just quantitative is such a complicated sounding thing. But you know what I would like to do today is just tell you over the next maybe 10-15 minutes how quant is already in some way in our lives, how we are subconsciously using it. And then more importantly, we'll talk for about 10-15 minutes on what our new product offering is all about. So yes, so thank you again on behalf of Axis. I have with me my colleague Shoaib. Shoaib is a senior professional with more than a decade of experience. A lot of the things that we are going to talk about today have actually been designed by Shoaib. In fact, I think in some sense, he will also be helping me with the Q&A, which we hope to have at the end of this session. So yes, Shoaib, can we get to the presentation, please?
Yes, sir.
Next slide, please.
We can begin.
Yeah, I think the concept is very, very clear. I think what we're trying to do here is use data, which already, by the way, gets used a lot, but use it in a far more systematic, rule-based manner to try and come up with a set of investment outcomes which will possibly add value to your investment portfolio. So in a nutshell, what I'm going to talk about for the next 45 minutes is what I've just said in the last 30 seconds. The next slide, please. So how does this work? I mean, largely what does quantitative do? I mean, there is, as you know, in life, there is a process of selection and there's a process of elimination. I mean, this can be demonstrated by use of a simple buffet counter. Like, in the good old days, and I'm really missing that. Before the COVID hit all of us, we had, we used to go to these mega weddings. There will be various food counters all over the place. And you can't eat everything, right? I mean, even though we all have very good appetites, Indians love a great meal. But having said that, nobody physically can go out and eat 45, 50 different types of food. So what do you do there? You select some and you obviously eliminate some. So let's say in my case, for example, I'm a South Indian. So the first place I will not go to is obviously the South Indian part of it because I get enough of it at home already in my part of my normal diet, right? So I guess the key thing there is this we're doing in some sense already very, very subconsciously in life. And this is broadly, if I were to just summarize and put the fundamental, the big click for us in this product is there is in life a process of selection, and obviously there's a process of elimination. Yeah, sure. So this is essentially what quant does. I mean, it does in a systematic way. It allows you to select certain things. It allows you to eliminate certain things. Now, obviously, in the financial jargon world, quant uses a lot of technique. We do it already. I mean, if you want to do the same process, actually works very well for us even in health. Obviously, if you select good food, you exercise regularly, you eat your fair quantity of fruits and vegetables, you get good quality sleep. You know, if you get these four things right, broadly, you are going to be in pretty good health. What you need to eliminate, or what ideally should be eliminated, is junk, obviously smoking alcohol, and obviously other things like sugary drinks, oil and stuff. And we know this, intuitively we know this. And subconsciously, we try and do this in our day-to-day life. Even in financial planning, sure, I'll tell you when to move the slide. Even in financial planning, it's the same logic that works in. I mean, ideally, if I had done what I had I have ourselves written on the left-hand side, which is that you have the right, obviously, money in the right asset classes. You put a good mix of MF schemes. So I can tell you that when I started my career 20 years back, one big mistake I made was that I put all my money into these so-called sectorial funds. But they were very, very sexy at that point of time because, the world and his uncle was buying technology. I felt that technology was going to change the world. And rightfully so, it did really well for us for a brief period of time. But obviously, like everything else, I think if you're over concentrated in a particular set of schemes, it can really create havoc. The other thing, of course, is maybe I didn't get the right advisor. I didn't read the right amount of books. Insurance is something that I keep talking to all my investors about. I mean, the faster you do insurance, the more cheaper it is. So ideally, people who are watching this webcast, I think one thing that you should do is obviously the younger you are, the healthier you are, the lower the premium you pay. So you get the right term insurance, the right health insurance. These are all things that add to your financial wealth. And this will show up. What can mess it up, obviously, is wrong investment products. Taking loans for consumption. The worst, in my opinion, the worst red letter thing you can do for your life, because you're essentially gambling away your future income for something that you may or may not need today. And obviously wasteful expenditure, which unfortunately or fortunately we do a lot of. I guess that's part of it. And you get these things only on the benefit of hindsight. But if you can keep your selection to the left-hand side, which is the right asset class, the ideal mix, the right advisor, the right insurance product, I think broadly you'll be absolutely fine. And hey, what happens in fund management? Yeah, next slide, please. So, what happens in the fund management space? My fund managers are also essentially, when you look at their life, and people ask me, how does a fund manager, what does he do during the day? His job is actually quite simple. His job is, it's actually on this slide. He has to select the right business, obviously from both a growth perspective, how it's going to do. He has to obviously buy at a reasonable price, because obviously in today's world, as you know, markets are at different highs. The right price is a tricky proposition, right? I mean, and you're paying for something today which will hopefully give you great future value in the future. And more importantly, you should try and avoid churning, because I think if you keep running from one hot stock, as I might use the word, to another hot stock, I think the guy who makes the most money is the broker, not the client. So what do you avoid then? I mean, that's the selection process. What do you avoid? What do? You avoid bad businesses, obviously businesses which have had a track record of not being delivering value for their customers. You try and be too overweight on a certain set of sectors or stocks. And sometimes even fund managers do that. I mean, they like a particular sector, they like a set of stocks, they just go completely overweight, as you say, or maybe overbuy in their total portfolio, which is actually not a very good thing from a total risk and a total return perspective. So it's the whole theory here is that I think it's very simple, and I think our whole life is actually based on making sure that we select the right things, be it in our personal life, be it in a silly thing like a buffet, be it in our financial management, in our personal financial management, and obviously in our context as a mutual fund management. And I think that's where Axis has actually been able to stand out, because we've done more of the left and hopefully rest of the right? Next, please. So I think it's a decision, right? I think, and so how do you make these decisions? I mean, ideally you make these decisions by if you're a personal investor or you're a personal consumer, you base it on your preferences, likes, dislikes, which is very easy when it comes to things like food and clothing, because we pretty much know what we want to do there. But the tricky part is doing it actually in the financial services space, right? Because that's the one where biases come in. That's the one where your last experiences come in. And this is what actually sometimes makes you make poor choices, right? And how can we prevent this? I mean, there are 3-4 ways. Obviously, one is to be very disciplined. Easier said than done. But yes, easier way, which is actually being used a lot today, is just to look at data, right? And if you look at data across various time frames, sectors, stocks, your own life, you will find that your quality of decision making and gets much better. And then more importantly, obviously in today's world, because speed is of essence, it is also, you may get it done much faster today. So in some sense, what one tries to do is take away the emotional aspects of investing, which is very difficult to do on a day-to-day basis for a normal investor like you and me, because we all have our own preferences, likes, dislikes, and all of us are very unique. We can bucket people into whatever age category we want. We can bucket people into their salary levels. But fact of life is that every investor is completely unique. And what one tends to do, or what tries to do, is to try to use data to make sure that those biases are in some way lessened as far as possible. Yes. And next slide, please. So I think if you look at how is this already affecting you, I mean, if you look at e-commerce, for example, all of us know when we open, for example, let's say a Flipkart, for example, or on an Amazon, any of the large platforms which are there, the Geo, the first thing that you see is the selection that you bought, and it asks you, do you want to buy it again? Because most people tend to buy the same stuff again and again. It's repeated, right? Suddenly you will get a pop on your phone saying, hey, the cornflakes that you bought, XYZ brand is now available at 20% discount. Click here. And most of us are doing that. It tells you, if you keep ordering in a way, it tells you today that, how many people are actually doing similar stuff to what you're doing. So it's in some sense giving you a sense of comfort that you're not the only person in a particular category or trying out a particular product. And very clearly it shows you on the top, what are your top categories. Now, if you look at it, this is in some sense very, very personalized. It's very customized. This is already happening. If you go to OTTs, for example, which is your Netflixes of the world, you will find suddenly the stuff that you've been seeing for the last 3 months. You scroll down and it'll tell you, hey, this is the show that's just come up, which is very similar to the viewing that you have. Or if you see a particular genre of movie, let's say if you're a very I love watching comedy. Like, for example, for me, that's my de-stressor. And I don't mind seeing the same movie again and again. But I keep getting pops on my TV that, hey, this is a new comedy show that's come, or this is a new stand-up comedy show which has come. So why did you look at it? Now, how is this happening? I mean, you guys, it's for us now, it's actually become second nature, right? We know that it's already, we use it so much. But if you look at the science behind it, the science is nothing but data analytics, right? And that's what. Next slide, please. And that's the rules. So it's very clear. I mean, for all of you who have sort of want to get into why this happens, it's actually nothing but a set of rules and data analytics. And people are writing code, and that's the whole magic today of data. Because now data which used to be in a very, very large, unstructured, in some sense, unusable format has now become very, very structured, very usable, and more importantly, the computing power, as you know, just keeps multiplying year after year, decade after decade, right? I don't want to get into that, but today, the phones that you and I use are, in some sense, much, much more powerful than the supercomputers of the 1980s. And that's how the computing power is actually just sort of, just kind of exploded. So when you look at this, and you look at the kind of data that is there available around you, and I don't know, it's a very often quoted quote, but yes, I'll say it anyway, but people say data is the new oil. Why is that? Because I can make a set of personalizations follow you. This largely works on the process of selection and elimination. So the data essentially tries to tell you what you like to select, and then more importantly, what you like to eliminate. And in that process, it hopefully tries and makes you a better decision. Now, this is the background, right? Now, you guys must be wondering, why is Raghav Iyengar giving me a 15-minute story on the use of data? Most of you, maybe I have a lot of people who log in from Bangalore, from Gurgaon, and you guys are far better than me at all this. So I don't want to waste your time telling you why. The reason that I'm giving you this background is because this whole last 10 minutes of stuff that I've talked about can actually be used very, very beautifully in the investment management world, the MF world. Yeah. Next slide, please. So as you know, it's all around us. Rules and data can be used in investments, and this is what the Axis Quant Fund aims to do. And we'll try and have a look at how it is already affecting us in the investment world. Next slide, please. So it's if you look at data, for example, I think what it also does is that it creates a huge amount of these are called what you call global multi-factor investing. Unfortunately, in the financial services world. One confession I have to all of you as my viewers is that it essentially we try to make we jargonize things, and multi-factor is nothing but looking at a various set of rules to try to formulate and make sure that the investment strategy is getting followed, right? So what do quant funds do? I mean, quant does pretty similar stuff. We use huge mathematical models to try and figure out simulation using past data, seeing what happens in how using past data can be in some sense try and predict what will happen in the future, right? And if you combine these two, use this multi-factor plus quant, and you put it into a big data analytics engine and use some of the techniques that are available today, the programming languages, the methods, I think what it does give you is a set of interesting investment ideas which can be used to improve your investment experience. Yes, next please. So, I mean, this is broadly what I wanted to talk on the quant fund. This is how quantitative techniques are used. In it did just to go back. Sorry, Shweb, just go back, please.
Yes.
What it is doing to us today is that this for us is used to be a very, very big. To give you a history of this, this used to be a reasonably large asset class pre-global financial crisis, right? And I think then obviously post the GFC, because a lot of this uses data, and one thing which we learned in the global financial crisis was risk, and I will talk about that a little more. We find that this category now is really shot up again internationally. So I think one big, and why is that happened? I mean, if I were to look back, is it so many people have asked me, Raghav, are you sort of reinventing or rebringing back the old flavors of, let's say, the 2000, late 2000 era? Because quant funds were very, very large at that point of time. And then obviously over the last 5, 7, 8, especially in the early part of the 2000, maybe 10 to 15, investment experiences are not very good. Obviously, it didn't help at that point of time. So I think people have asked me, why are you guys sort of re-churning and bringing back old ideas? I think no. I think three things have happened. One is, as I discussed in the last 10, 15 minutes, huge jump in the element of computing power which has happened now. And that thing is yet working as I'm speaking to you, right? So I don't know what will happen to our phone memories. I don't know what will happen when 5G comes in. So much of stuff that's happening around it. Number two, I think regulators all over the world, and more so in India, have insisted on much higher levels of transparency. So today, for example, if you go to a company website, you will be able to see who are the analysts, who are the investors who have met a particular company in the last, and in fact, it actually happens before the meeting. They're supposed to put it up before a meeting. All public limited companies, if I'm going to meet a company, we have to tell, and this is available in the public domain, right? You can figure out, apart from the normal parameters which are there as to how a particular company, if you go through, for example, the notes to accounts, which is, in my opinion, a very, very big source of information for figuring out whether a company is doing well, whether the sector is doing well. You can figure out, you can now put all those data points available there in terms of it. And data normally is not only, by the way, not only quant, it's not only maths, it's not numbers, it's also physical. You can also see and you can track what a company's management said, what it did. All that is easily available. I mean, if I were to go back to my start of my working life, maybe 25 years back, to do this in a physical format was practically impossible, right? Those are days where we used to get to office early so that we could read the business standard, which was there even in those days. They have a money market page, and we used to look at that money market page because the guy who saw that page first actually had a heads up in terms of some of the other people because he had access to data faster, right? Today, that's not the case. I mean, today it's actually frankly your habits. In fact, today I think it's the other thing. We've got a surfeit of data which is big. So I think today these are the big things that are there. I think one is massive amounts of computing power available. Number two, massive amounts of data available about companies. Lastly, massive amount of customer data also. So if you look at it, I mean, next week, for example, we know exactly when there are three big data points happening next week. There's a US job report, there's a China report, there's the Japanese, the UK central bank reports. All this, in fact, it's the other extreme now. I think you've gone into a situation where you have excess of data. So I think this is where we spotted an investment opportunity. We said that India is also now far ahead, and this is something which, frankly, this is where we've jumped generations. Actually. So we are actually in a situation today where, let's say, for example, in our mutual fund industry, the level of transparency is now actually possibly amongst the highest in the world, even though we are a very new industry compared to, say, some of our Western peers. We are hardly, in some sense, a 40-year-old industry. But our disclosures are much, in fact, they're as high as possibly the US or maybe developed markets, as we call them. So that's the fundamental thing. And what we do in Access Quant, I'll just quickly take you through that in the next 10 minutes so that then we can have a nice interactive session. Yeah, sure, please. I think so. This is essentially what Access Quant will do. I think we already do this on the left-hand side. And what we intend to do in this case in the quant is actually use a set of rule-based criteria to try and marry it with our fundamental approach. That will give you a set of investment opportunities which we put into our Access Quant. Now, how do we find these level of stocks and what's our investment process? Let me just quickly take you through that. Yeah. I think broadly, as you know, we have three philosophies. Access is always stood for quality. I mean, if you go back and look at our, we have now a 10-year track record of managing equity, 10 plus years. And if you look, one common theme across all our portfolios, whether it's large cap, mid cap, small cap, is that there is a huge focus on quality and there's a huge focus on earnings. And so we call this philosophy that we use here in this product called QGAP, which is basically we're looking at quality and growth, obviously at a reasonable price, right? So these are the three big drivers of figuring out whether a stock will make it to the portfolio. Yes, next slide, please. I think some of the ratios that we look at, obviously, in the portfolio, is obviously some of the things. And this is just a snippet because actually, if I were to look at the number of things that our fund management team looks at, it's far more. Maybe I'll spend a long time discussing it with you, but just to show you growth, for example, we look at earnings improvements. Analyst forecasts are very critical. When you look at valuations, of course, you have price to sales now, which is an interesting new barometer which has come apart from the PE, PB. Quality, of course, the most important thing now in today's world is, of course, the debt equity, which is something that we've been looking at for a long time, but which is again got a lot of prominence. And more importantly, in today's world, the volatility of a particular stock. So if a stock keeps gyrating too much for no apparent reason, maybe there are some issues on quality around. So what this does is that we put, next slide, please. We put all these things together, right? So we have the stock name, we obviously have the sector, and we put the scores that we get in each of these types, or rather each of these attributes, which is quality, growth, and valuation. And we come up with what is called a composite score. And this is done across our entire universe of stocks, right? Now, many stocks will just not make it to the list for the simple reason is that they are just absolutely, they don't provide that level of data. So obviously the more transparent a company, the more forthcoming a company, the higher are its chances of one being included in the list. In fact, without that, fundamentally, they will essentially get knocked off for lack of disclosure itself. So what this does is that it tries and eliminates. So I think that so people have asked me, what is that fundamental big difference between what used to happen 10, 15 years back? I think earlier we used to the industry used to just take a set of numbers and run it through a particular model and not apply too much of risk management. I think in today's world, I think the difference between the first decade of investing and today is that I think risk management has become a far greater criteria for investment apart from the usual numbers and commentary that we tend to look at, right? So obviously, the higher the weightage, the higher the composite score, the higher the possible weightage of that particular stock. So that's broadly it over there. Next slide, please. So when you look at it, I think obviously you have 4 boxes here, as you can see. The middle box is the portfolio. You have obviously a composite ranking. You have a stock level constraint, We have a sector level constraint. These are things that we have put in internally to ensure that there is no overexposure to a particular stock or a sector. And then obviously there's a stock risk, which we measure in some sense by liquidity and obviously by volatility of the stock, right? So I think all this happens, and we will be rebalancing this portfolio at a predefined frequency, possibly once every month. And unless, of course, something really changes, you, God forbid, have a large market movement because of maybe COVID or something else, you could that will obviously we will ad hoc it. But otherwise, largely this is a portfolio which we don't expect to do too much change. Once a stock comes in, makes it to the composite ranking, tick boxes all the constraints in terms of sector stock and uh, liquidity risk. Broadly, it will stay in the portfolio until something dramatic happens, and or the valuations or any of the other four things that I spoke about, valuations, growth, and quality. Any of those tend to get affected, then obviously that would have repercussions on the composite score, and then obviously repercussions on the weight of the stock. Right. Next slide, please. So just a quick snapshot. I think largely we have the universe of listed stocks. Obviously, you will eliminate, as I said in the beginning, the whole fundamental thesis of the whole investment world or our world today is selection and elimination. We start with the entire universes of listed stocks. We have the elimination criteria, which is based on data, which is QGAP, whether it kicks off there, market cap, or liquidity, companies which are red flagged, and this is where the fundamental analysis or the traditional way of fund management comes in, because all these companies will then effectively get eliminated. And then obviously what gets left over gets scored. As I told you, you have the QGAP philosophy which comes in. Each stock gets a particular amount of ranking. You have a total composite final score. And then ultimately you figure out, you use that set of stocks and you optimize it further based on the composite rank, the risk of the stock, which is again measured by liquidity and by volatility. And then of course you have stock and sector constraints. And stock sizing is nothing but just making sure that the portfolio is not overly exposed due to liquidity and given the total amount of the portfolio that we have. So what we will do is possibly what it will in effect give you after this whole process is it will give you a set of maybe 50, 60 stocks, multi-cap in nature. We are not, in that sense, we will not eliminate a stock because it is small cap or mid cap. Obviously, it will, in some sense, get affected in terms of sizing, because obviously the lower the liquidity of the stock, lower the floating stock, lower will be the composite score and the optimization score, which will reduce the allocation to that stock. Right? But yes, we are in that sense sector agnostic, we are style agnostic, we are market cap agnostic. What I mean by agnostic is that we really don't, like, let's say if you go and many of you have.
Hello. So, Raghav will be back soon. I will just take over from here. Primarily, what as Raghav sir had mentioned that so primarily this portfolio will consist of 50 to 60 stocks, and as he has already stated that the scoring and ranking and the entire elimination, everything that has brought it down to that 50-60 stocks, basis on the number of factors or the different portfolio criteria or the rules that have been set up. It will be using it to decide as to how much of allocation is given to each and every stock, and it will also take care and basically ensure that you are not overexposed to any specific sector, because often what happens is that due to some run up in the market or due to a flavor of the
I'm back here. Sorry.
Okay, thank you, Raghav.
Yeah, I'm so sorry. This is one of the challenges that I think all of us get stuck. Sometimes internet tends to go off. So I think, of course, work from home has made us all, in that sense, very risk conscious also, because we also have become. Sure, I can't see my screen. Am I audible, visible?
Yes, you are visible and you are audible.
Okay. So
The
sorry.
screen is open. We are still on the same slide where we are summarizing the entire portfolio as to how the stocks are selected and portfolio
Yes. Like
created.
I said, I think that's the. Uh, yeah. I'm sorry I got dropped off, but yeah, I'm back here now. And I think that's the whole the beauty of this is that, as I said, this is a multi-cap, multi-sector process. We are not eliminating any stocks because of capitalization or anything in the initial stage. Yes, of course, they will get their respective weights adjusted because of liquidity and obviously because of floating stock. But at the initial stages, there is no thought process. Can we have the next slide, please? So I think what are the benefits? I think very clearly, as I said, to have objective investment decisions. I think that's very important because uh, human beings do have a bias, however good, bad you are. And I think if you look at large and very, very experienced fund managers too, I think they have everyone has a certain investment bias. In fact, most of us spend most of our lives trying to overcome those biases, right? I think so. Obviously, using quant, which is in some sense an impersonal way of looking at things, is one way to minimize that. Number two is, of course, as I said, use the entire stack of data analytics for your strategy. I mentioned that in the beginning, computing power has gone up. More importantly, the amount of data available to us in the public domain to select companies is really dramatically increased, especially in the last 5 years. We have to thank our regulator for that because without that push, nobody wants to disclose. And that's one way of also making out whether a company is a good quality company or not, because companies that disclose more, obviously, in that sense, get higher weightage. I think obviously we take out the human emotion and the bias. So I won't say we can completely remove it because it will always be there in some form, but we try and reduce it. And what it obviously does is because of the stock and sector sizing and the liquidity sizing, which I spoke about, you have a slightly better risk management process, which is applied to this portfolio. So I would say it's a mix of both, a beautiful mix of both ways, a fundamental and a quantitative way. I think fundamental and a data analytics way. It's a mix in some sense of art and science. And we hope that that will give a good investment experience. Yeah, next slide. So just a quick 5 minutes. Obviously, this I've spoken so much about. I think the important thing is to try and tell you how this is done. So this model has been running now for some time. We have a specific team within Axis, which has designed this model, which keeps adjusting it for data. We just like to take you through how it has done in the last, especially in the last 3 years. Next slide, please. So if you see over the last 3 years, that has been there. I mean, it's over the last 15 years at this data. And why am I put only CY14 and not CY00? Because a lot of the data changed a lot post 14 in terms of the disclosure. And if you look at the way the model has behaved, I think it has beaten the index. We are using, as I said, the BSE 200, which is a mix of large, mid, and small cap companies by a pretty handsome margin. I mean, in the last 14 years, it's beaten the index about 10 times, right? And with an average outperformance of almost 7%, which is would place it possibly among the better performers in the entire sector. Now, many of you will say, I don't care what happened, say, 14 years back, because there's been a big difference in the way life has moved, especially in the last 14 months, right? And that's true because I would have never expected a 2020 kind of a market in my career. And I thought 2008 to 2010 was possibly a bad period, but what we saw last year was in some sense much, much worse. And so many people have told us why. So one thing we decided to try and figure out is that how it is done. Because thanks to COVID, we have had actually maybe 5 or 10 years of volatility getting compressed in just about 12 or 13 months. Maybe the next slide will tell you how we've done that. Yeah. So if you see, this is a 3-year rolling return put down in a chart. And as you can see, sometimes data doesn't show it very well, but as you can see throughout, except for slightly brief periods of time, you will see that the model has done, the red line is obviously the model, and the black line is the BSE 200. You will see that the red line is largely consistently above the black lines, in which case the model has done quite well, right? If you see how has it done outperformed? It's outperformed like 99% of times. The other interesting thing which you must understand is if you, on a 3-year rolling basis, that means ideally if you had been in this model and continuously stayed there, and you keep rolling at it, you will see that it has never given a negative return, which I think is very important for us in today's market at least, because we're all, the big question that I get all the time is that, hey, 52,000, should we be buying equity or not? And I think by putting some money into a product like this, it will, at least the data shows that negativity gets much, much less reduced. Yeah, next slide. And this is coming back to my point. I mean, if you see the way the market crashed, and that's the waterfall of the 2020 era, I mean, the March 20. And then more importantly, look at the way the product went up, right? And both ways, if you see the market fell much, much lesser compared to the market again. And more importantly, when it went up, it rose much faster. So we were able to, using the model, capital which got destroyed actually was recovered almost about 4 months earlier as compared to the benchmark. I think if you had stayed invested in this portfolio, you would have made back your capital. Your 100 became, as you know, 80. And the 80 to go back to 100 happened much, much faster in using the model over here in the quant. So broadly on the performance, as you can see, it has done very well on a longer term basis. On a 14-year basis, it's beaten the benchmark more than 99% of the time. On a 3-year rolling basis, it's never given a negative return. And then, of course, the recent crash and boom, which we are all unfortunately or fortunately have experienced, again, you can see it's done reasonably well. So this is, in some sense, attribution of how the performance has been using that model. So I spoke a lot about how we do selection and elimination. We spoke about how Quant has helped us to select and more importantly eliminate. We are already doing that to large parts of our routine life. We spoke about how Quant has been able to do that in fund management. As I told you, a lot of it is actually happening. Quant funds are very, very large products internationally. In fact, all the new money which is coming in active management abroad is actually, a lot of it is going into Quant. We've seen what we want to do in Access Quant, the QGAP model, how we are going to get a composite score, and then more importantly, how we overlay our risk management on that. And of course, the last 5 minutes, I've tried to tell you about how the model has done in real life, which is over the last 15-year period, 14-year period, and of course, over the recent past days. So next slide, please. So why do you need to invest? I think it's a unique offering. It's not, of course, that's not to say that you must put money. I think the important thing is in point 2 and point 3, which is it's unbiased. That's very important today, given where markets are right now. Number 3 is very, very important because it's diversified. I think today, the big mistakes that I have seen investors making, whenever there's a huge market rally, they try and get into, they concentrate risk into a particular set of sectors or a particular sector. And we have seen this happening in the last 1.5 years. We saw a huge amount of money getting into pharma, then we saw it getting into banking, then we saw it getting into technology. Our belief, or at least my personal belief, is that I think a diversified portfolio across market caps and sectors is actually much, much better for a retail investor. We would rather give that flexibility or the freedom to the fund manager to decide what he has to do. So people who want to put money, I think importantly, of course, it's a different way of investing. That if you like the product doesn't mean that you should take all your money and put it in. Obviously, I'm going to put a fair amount of money myself personally into this product. Anyway, skin in the game, etc., etc. Number 2 is, I think that's the second part is more important for me personally. It should be for you. This is not a short-term product. This will take equity today. If you're coming in, you must have a minimum 3 and ideally a 5-year view. And obviously investors with some level of high risk appetite. Because all equities today, as you know, there is a possibility of at any point of time. That's the fundamental game of equity, that equity does give you capital losses. So obviously you have to have a reasonably high tolerance for this. Okay. A quick snapshot on the product again. I think this is next slide, please. Our last slide. And apologies, I'm about 10 minutes over time. But yeah, this is broadly the product details. Benchmark is important. As I said, it's the S&P BSE 200, which is a mix of large, semi-large, mid, and small cap. And of course, as I said, it's an equity fund, so 80 to 100% is there. So that's my last presentation. Thank you very much. And I'm again, apologies for dropping off briefly for a minute or two. We're really happy to now take some question and answers. Shoaib, will you guide us through that?
Yes, sir. We have got lots of questions. So I'll just ask few of the most common questions that I've been seeing continuously in our chat screen. The first question would be, what would be the benefit of the Access Quant Fund for an investor's portfolio?
I think let's just go back to one slide before. I think that's the whole benefit. Sorry, if you go back one more slide, you'll understand.
Then,
I think that's in some sense the model. The benefit is, of course, as I said today, you need a broad-based fund which goes across sectors and stocks. I think today in my life, for example, I can tell you that I started investing in 97, 98. I started off with exactly what I'm talking about now, multi-cap, multi-sector. And then I'm sure many of you, I don't know how many of you were around in 99. That was a great tech boom rally. Then I took out all my money and I put it into a set of technology and IT related funds. And this happened in the end of, or rather the third quarter of 1999. Until February 2000, I was, really patting myself on all parts of my body, saying that, hey, I have really done well because look at how these diversified equity funds have come, I've beaten them. And April 2020, the market just, tech sector, not market, and to be specific, tech sector just went boom. It just sort of crashed out of control. You had a situation where I lost, at the end of 2020, I had lost 70% of my money completely. It was such a big mess over there. So I would really, at this time, and that's one big benefit, is that take away every time the market tends to go higher, people's emotions, people's biases go up. It's happened to me. It happens to fund managers. That's why Quant helps you, takes away some element of bias. And then more importantly, the Access Quant Fund is, as I said, multi-sector, multi-cap. So it allows you to essentially participate in all sectors of the economy.
sir, the second question is, how long should I keep invested in this fund? So the gentleman is already having an SIP of 2,500 in our FlexiCap fund, and now he's also thinking of starting an SIP in the Quant Fund. So his basic question is, what should be the allocation level that he should do for a Quant Fund?
I think for me, this is as I said, a multi-cap fund. So for me, a multi-cap, flexi-cap product, as I said, because they allow tremendous flexibility to the fund management team to really rebalance stock sectors. For me, it's a fill it, shut it, forget it. So I would be invested in this fund till as long as I don't need the money. But ideally, as I said, because we are getting into a market which is reasonably expensive, at least in the short term. So I think one must have a longer term view when you're putting in money into equities today. When I mean equities, I mean any equity, and more so for a fund like this. So because it's a fund, you have slightly more diversification. So minimum 3-year view is at least required. But ideally, as long as you go, that's the experience. The longer you hold stocks, the better your chances of having a good investment experience. Right? SIP, I congratulate you, sir. If you've been putting money, please put more. One of the big reasons that I am where I am today is because of SIPs. It's a beautiful, fantastic way. I think one thing that the industry has done and done well, and more so even in Access, I think we're really, really happy with the way the money is coming in SIPs today. That's a beautiful, disciplined way of putting money. Sometimes it does because, but I think one thing we must understand is that SIPs are not an automatic. It's not a magical wand. It is a beautiful way to save money and to allocate money in a systematic manner to equities. If markets go down, that will also go down. And the same rules that apply to equity apply here. In fact, more so, because I think the longer you keep it, the better it is. I was looking at some of my own personal investments yesterday. Some investments which I put 10 years back have just given me, even after this market rally, just given me a 6% return. But I'm pretty sure that I don't need that money for the next 5 years. So I'm pretty sure after 5 years, when I look at that statement again, I will be much more hopefully pleasantly surprised. Right? So stay invested and yes, keep putting money in this.
Another common question that many investors are asking is that the market has reached its all-time high, and isn't valuation a concern at this point? And would it be prudent to book some profits,
Sorry,
or wait for some time?
we've never been able to. I think I've never heard anybody accurately predict both the market going. I mean, the market bottom and the market top. I've been seeing and really looking for this messiah for the last 20 years of my career who has been able to make a specific pronunciation on it. Right? So I have only realized one thing, dear viewers, is that I think your time in the market is important. So please continue to stay invested. I think everybody has to have an asset allocation. I spoke about this briefly about a month back. I think an asset allocation is, uh, yeah, just go back to the previous slide. Just let it be on the previous slide. The asset allocation is important. It's very unique to you. It is your risk tolerance. You have to ask yourself some basic questions. How ultimately we invest for a better future, and more importantly, we invest for a better current, uh, good sleep, if I may use it. So if you're not sleeping well with your current investment strategy, then I think you need to tweak it up. So, well, that was the behavioral part of the answer. The technical part is yes, I think 52,000. The markets, by the way, have been expensive not in 2021. They've been expensive all the way since 2018-19. So, if you look at the usual financial parameters, markets have never been cheap in the last 3.5 years. But had you based your investment decision on those parameters, you would have possibly missed out on maybe one of the better wealth creating opportunities that equities have provided in a long time. So again, my going back to my first point, but companies today, I mean, the people we speak to, especially the larger companies, the companies who are more resilient, who've been compounding money, they have been uh, very positive, and largely because of three things. I think one is obviously lower interest rates have helped a lot of people boost their bottom line. Number two, the environment has become much more conducive to raising money. And if you see the amount of money the amount of debt reduction that has happened in the last at least 12 months is not funny. Uh, Lastly, but not the least, I think you have some reasonably high quality money coming in, uh, both from overseas and local. And that's also adding an element of buoyancy to the market. In some sense, it's a bit of a tale of two cities because you have the listed stocks, the good companies which are really doing well. They're taking advantage of the environment, the lower interest rates, the pro-business outlook of the government, the slight tilt away from China because of all the usual political issues which are happening. There are a set of companies, SMEs, small business owners who are yet sort of struggling a bit. So I think in that sense, uh, obviously the listed world is doing far, far better. And that is getting reflected in the market valuation.
Okay. And we are also getting a lot of questions where people are asking that how is Quant Fund different from other funds of Access Mutual Fund? As in, these parameters will also be used to manage other funds, and what will be the what will be the fund manager discretion in this fund? Will they be choosing stocks, or how will they be positioning themselves?
That's a very, very good question. Fundamentally, as you know, Access has always stood for quality and growth, right? And that's what we started off with by saying that this fund will use the Q gap, right? So it will look for quality and growth at a reasonable valuation. So that principle stays the same. That's not going to change at all. It's not that we are going to have a completely new philosophy when we are managing funds. So that underlying foundation is where this fund is very, very different is that once based on the composite score and the optimized score after applying the risk matrix, you get an optimized score and you get a set of say 50 to 60 companies. That's where the bias completely goes. In a normal mutual fund, in let's say my blue chip fund or my focus fund, the fund manager does have the right to move that a bit around. I mean, whereas in this case, there is nothing that the fund manager can do. Once the model throws up those 50, 60 stocks, he has to buy in that proportion in the portfolio. So we are trying to remove that little bit of bias. So in that sense, it's a little lesser biased, but it's, as I said, more data driven. It's a unique offering for us also at Axis because we are trying to marry two very different concepts here, which is fundamental and quantitative. And hopefully that experience will be good.
So there are some investors, sir, who are also asking, will this fund have a higher churn than normal funds? and will it have any impact on the cost of the as in the expense ratio of the fund?
As I mentioned, Shoaib, I think the plan is not to do a frequent churn. We will look at rebalancing this portfolio once in a month or whenever something fundamentally changes, either in the market valuation or with respect to a particular stock. Right? So the plan is not to, and which is pretty much similar to what we do in our regular funds. So I don't see too much churn difference. There could be a little more because it is a value, it is a model-based fund. Some of our schemes also look at a 3-year forward earnings. Obviously, they have much lesser churn compared to, let us say, Axis Bond. We look at, let's say, growth, for example, from a 12-month forward perspective, right? So in that sense, yes, there could be a little bit, but not fundamentally, not too much. And as far as costs are concerned, I think yes, I think the thing, one of the risk parameters that we have put in is obviously the volatility and the floating stock of a particular, the floating amount of a particular stock. So I don't want to, so we will not, the impact cost will not be as high as what is being thought.
Okay, while there are many questions that our investors have been asking, I'll take two more questions.
I think we should, given that it's a Saturday, we can possibly stretch it by another 5 minutes, maybe go up to 11:35. So whatever we can get done, show up in the next 10 minutes.
Okay.
Maybe also, so you could also possibly just, I don't know, maybe just write into us, show up maybe once at the end of the thing, you could just sort of tell the investors your email ID so if they have any questions, or they can just write into Access and we'll come back to you on if you missed out anything. Yeah, but let's continue.
Okay. One question that we are getting is, will the strategy also look to time the market, as in raise higher cash levels, or will it always be fully invested?
It will be fully invested. I don't think cash is a strategy that we plan to have here. If it is there, it may be because of flows. Let's say, so when do we disclose portfolio? As you know, we disclose portfolios twice a month. That's a regulatory rule now, middle of the month and end of the month. So let's say hypothetically, I raise say 100 crores in this fund and I get suddenly 2 crores to, on the 30th, it will show up as 2 crores of cash because, we may not have had time to invest because it would have just come in during the product time. But there is no cash strategy, if I may to use the word, in this product at all. We plan to be fully invested.
Okay. Another question that a lot of people are asking is, what would be a better way of investing in this? Should one do a lump sum investment in the fund, or should people do an SIP in this fund?
It's a very good question because I keep asking myself that question. I plan to, or my personal part of it is that, let's say if I have X to invest, I will put about 50% of that X in the IPO itself, which is closing on the 25th. And the balance 50%, I plan to just put it as a SWP or a SIP format for the next maybe 12 to 18 months. But that's me. That's me. I don't think that applies to every. I mean, that's where I say that that's a very personal, individual decision. I cannot sit here in my house in Bombay on a Saturday morning and give you some global gyan as to how to manage your portfolio. It is based on your risk tolerance, how much money you already have in equity. Are you looking, which parts of equity do you own? If you are, let's say, very heavily invested in small caps, cheers to you. You've done very well, especially in the last 6 months. But you're going to add, are you going to move some money out of that into a quant fund, or is it just money which is coming out? Are you borrowing to invest, which you should, my opinion, never do? All those attributes come into play. But I think a mix of lump sum and SIP would be a good way to participate in this fund.
So one unique question that we have received is, how is the market supposed to react in case if there is a third wave of the pandemic, and will the fund take any strategic decision for the same? And if you have any suggestions as to how individuals should prepare for it financially.
I think fundamentally, third wave is a big question mark. Of course, I think the fact is that governments are going to be definitely prepared. So you will see a fair amount of media announcements around this. I think Maharashtra is already talking about a third wave hitting the next 3 to 4 weeks. I think in the second wave, many people governments, individuals, companies were caught a bit unprepared. I don't think that is going to happen again. So now whether it comes or no, frankly, I'm not the expert. I have no idea. What I do watch very carefully is vaccination. And I would be very worried if the vaccination comes down dramatically on a week-on-week basis. I think day-on-day to monitor sometimes is a little difficult because India is such a vast country. And that is something that I watch out for. I guess if we get reasonably well vaccinated by end of the year, if about 40-45% of our population is, I think we will be in a far better situation to handle any future waves that will come. Because one thing that is coming out very clearly from medical opinion is that once the vaccination is done, the chances of hospitalization go down dramatically. And then I guess, and if you're just going to be sitting at home and taking treatment, I think the chances of a full recovery are very, very bright. So I think that's number one. Number two, how should one financially prepare? I think I have always had three things that I tell my investors, I think, or rather request my investors to do. One is keep 6 months emergency allowance. That should be put into something like a product, like let's say ultra short or something which is a slightly lower risk, lower volatility category, but which is accessible very, very quickly. Correct? So look at your last 6 months expenses, look at the core expenses, and first build up that buffer because life is uncertain. Number two is that you should keep, as I said, be invested in the market. Don't get carried away by 50,000 and 40,000 and 28,000. I think the fun in equity is to stay invested for limitless and long periods of time. That's so that you allow the benefit of what we call compounding. I think compounding, as you know, is the eighth wonder of the world. Fortunately, in compounding, there are three big variables, right? I think the amount of money that you invest, which is the P, the R, which is the rate of return, and N, which is the time. And unfortunately, what we tend to do is just focus on the R. And everybody around us, whether it is media, experts, everybody talks only about the R. Nobody talks about the P, which is how much you should actually be investing compared to your total wealth. And then nobody talks about the N, which is the amount of time that you need to. So remember that, be there and put money into equity only. Lastly, remember, I use this sleep well technique. It's not patented to anything, but if I'm going to keep thinking about my investments 24/7, then I need to rechange some of that. But if I'm sleeping very well, whether I'm at 70%, 60% of equity, frankly, I don't care. Because if I'm sleeping well, that's what I want. Then you allow the investments to do what they have to do. And then you have very good managers in the industry today who have been able to give a very good investment experience. And more importantly, you have fantastic products, new products which are coming out, which are based on, if I were to put contemporary things which are happening today. Quant is a classic case of it. I mean, Quant is in some sense using today's technology to try and make your investment experience better. So put something into that, and then let life take its course after that.
So one of the interesting questions that we have received is what has been the broad market cap allocation in our backtesting?
It's largely been large cap because especially on the liquidity and risk parameters, the filters really apply there. So it's roughly about 70% large cap and about 20-25% mid cap and about 5 to 7% small cap. That's the broad thing. But as I said, this is a dynamic model, so based on Q gap, based on the composite score, based on the risk score, that number could completely change. Currently, it's a 70-30 kind of a situation. Yes.
So one question
I think we should take one last question, Shwet, because I think I don't want to allow people to go beyond. My request again to all of you, if I have not been able to ask questions, my apologies in the beginning because I went off for a couple of minutes and I think I took 10 minutes longer than what I had budgeted in the presentation. So my apologies for that. But yes, if I've not been able to answer your questions, please email ID which is there. Please write into that. We will come back to you individually on that as soon as we can. Yeah, let's take the last question.
Okay. Would you like to use trading quant models to better the returns in volatile market?
I didn't understand. Sorry, can you repeat?
The question is that will we be doing a lot of quant model based trading or short term trading and
No.
trading?
No. I think At Axis Mutual Fund, I think one thing that we have done very well is that we try and understand the businesses very well what we invest into. So we are not, in some sense, a very trading-oriented fund house. Yeah, sometimes you get these tactical opportunities, but very far and few. Quant, definitely no plans on. As I said, Quant is very, very fundamental. We are just using the QGAP married to the quantitative techniques to give us a portfolio of stocks. And as I said, we will look at that once in a month. If something needs to be rebalanced because of some score weighted change or because of movements in price, we will trim it or add depending on what the score tells us to do. But beyond that, I don't think there is any plan to do any serious trading around it. So yes, compared to what happens internationally, and it's a very good question because internationally quant funds are in some sense using a lot of data and a lot of quantitative techniques to do high frequency trading. It is there in India too, but that's not what this fund aims to do at all. That's not the plan in this fund. This fund is in that sense more fundamental, more buy and hold, more more quality biased. That's what we intend.
Okay, thank you so much,
Thank you.
Raja sir.
Thank you very much, everyone, and really appreciate your taking time off on a Saturday morning to listen to me. I hope I've been able to add some value to you. Any feedback, any comments, most welcome. At Axis Group, we are always open to suggestions. We are always open. At Axis Mutual Fund, we pride ourselves on being a responsible fund house. So we try and come out with unique offerings which will add value to your investments over a long period of time, like many of our other products have. If you are our investors, thank you very much for being invested. If you are contemplating investing, thank you very much for contemplating investing in Axis. And thank you once again. Have a great weekend. Stay safe and yeah, God bless. Thank you.
Recording stopped.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.